The interest rate hike. Why the Federal Reserves are increasing the rates to fight the inflation. The Federal Reserve Authority launched an anti-inflation campaign this Wednesday. The main agenda here was the largest inflation which has occurred in the past 28 years. The banks are constantly trying to control inflation every day. The interest of the Federal Reserve Authority was itself increased by 3%, which might be the highest recorded since 1994. And this has occurred after there was a 2% increase which occurred from March to May combined. Even after such a huge increase, there was a prediction that there might be an increase up to half a point. But this idea received a well-deserved backlash because this has never been done before. About 8.6% was recorded to be that total increase in consumer cost per year. These consumer costs include day-to-day groceries, fuel, electricity, and other daily needs. It appears that inflation has now become more dominant than ever, and this will be a game changer for many people. Fear of recession is turning into a form of depression. The demands of the consumers have been limited in the past few weeks by government officials constantly increasing the interest on everything. So this is going to be a problem if you're going on a vacation or buying a house or paying the rent to live in an apartment. These interests have gone higher than we had imagined. According to the Feds, there was an increase of about 2.8% in the last couple of months, while this year they have said that there will be just an increase of 1.7%. So when we look at these statistics, it becomes more clear that the growth process in 2023 is going to be weaker, increasing the chances of a term called a hard landing. In this case, the economic downturn is boosted without any decline in price levels. What are the effects of federal cash rate increases on the economy? The main question which you all may have in your mind right now is, how can a single interest increase affect the economy so much? Well, the answer is simple. Banks will start to increase their bank rate or interest rate whenever they want to borrow money, and that too on regular intervals. The most obvious example of this can be seen in the phenomena of the prime rate. This is basically a luxury which is offered by the banks to their most loyal and beneficial customers. These may include huge companies and big industries. For most of the time, there's been a rule, which is that the prime rate must be equal to the total federal authority funds with the addition of 3%. This percentage will become 4.75% if the new federal authority funds are set at 1.5% or 1.75%. This difference in percentage is going to cover a portion of the bank loan statement. Whenever there might be a change in the prime rate, there is supposed to be an increase on loan interests and even other departments such as real estate or car buying, also the debts which people have mostly due to their credit cards. Increased interest. Is this a myth, or does it actually affect the economy? It is very important to put our demands and our supplies in line to each other if we don't want things to go out of hand. And this needs to be done now, or it might be too late. The main market is deeply affected by the present pandemic, and it has affected each and every product up to a very large extent. The main importers of products throughout the world, such as China and the United States, are also deeply affected. The world's biggest food chains and petroleum products are also affected. And the current problem going on in Ukraine has also severely affected the economy and has a huge role to play in the decrease of demands these products have. When it comes to inflation, it is basically controlled more by the Federal Reserve Authority as compared to the government. The term positive inflation can also be associated with the Feds because they can use it as a positive trading tactic. But as far as the government goes, they have to keep all this inflation in check and make sure to have strong policies for this subject. There's going to be a bad time before things start getting better. Whenever there's an increase in the interest, this comes with bad outcomes. But these bad outcomes are not here to last forever. These are just temporary and will pass soon enough after that it gets better and better. there exists this possibility that the people are going to pay more interest because of very high fuel prices, housing rents, and vacations. The daily wages and salaries are being increased, but let's face it, they cannot match the increased prices on everything. As a result, there are a lot of people quitting their jobs and people who are doing more than one job. As long as the prices go up, the economy is going to come crashing down. So the feds must find a solution for this problem for people to stay at their jobs and provide a backbone to the economy. They need to avoid both the downturn as well as overinflation. Getting things down slowly is not a solution when it comes to the topic of inflation. When the rates are increased day by day consistently, and that too by an excessive amount, this causes the total financial growth of a country to slow down a lot. Most of the experts are worried a lot about this nowadays. This process up and down is very similar to having a deadly form of cancer. It's extremely painful to treat, but one must bear the pain to remain alive. The feds are checking and making changes to the interest rates constantly in order to avoid a disaster. The tension going on in Ukraine has caused the fuel prices to touch the sky, and it is really starting to make people worried because people are paying too much now for something that they didn't worry about that much. But the federal committee still has played a great role in keeping everything in check, trying to avoid more interest on anything possible to help the people out. How are stocks affected by all of this? Whenever the prices go up this high, this negatively impacts everything, including the stock market. The stock market is dependent upon the prices because it is connected to all the private and government businesses. Both the sales growths and the share prices are always negatively affected by an increased interest rate. All the business activities seem to be paused whenever such type of event is seen to occur. Whenever there is an increase on the loan interests, an industry loses its product value and its investment is negatively affected. The higher the interest is, the more it shows that business is unable to grow. The investor who was thinking to invest in stocks or a large industry begins to question and think about the negative impacts it would have on his life. But there is a solution for all this. Instead of waiting for the prices to come down and the total interest to decrease, all the stock investors can turn on their defensive mode by trying their best to sell and reinvesting their stocks. I'm sure you learned a lot about what a downturn is and how inflation can improve or destroy an economy. Thank you for staying with us till the end. If you want to see more videos like these, please leave a comment below. Also, make sure to like and press the subscribe button. See you next time.